difficult job of introducing the speaker. Please bear with me for a minute. Mr. Amit Kumar is a member of the Chartered Accountant Institute and is a Bachelor of Commerce prior to that. Working with the ENY for the past 5 years, has more than a decade of professional post-qualification experience and also 3 years of core industry experience. He is a senior manager with tax and regulatory services practice of Ernst & Young in Chennai.
Pleasure to be here and addressing this forum. Whilst you have been speaking since morning on different aspects of the stock, associated with stock markets, this is going to be a change. Here we're just going to talk about taxation. And at the outset, I must give a disclaimer that I'm not a markets expert, so I wouldn't want to second guess where the markets are going. This is an overview of what I plan to do over the next 20 minutes. Taxation is generally considered to be a dreaded word in the lexicon of the salaried class as well as the business people, in as much as it cuts into your profit margins, takes away through TDS your paychecks. But when it comes to taxation of investments, fortunately the tax law through the years has always held out a more benign treatment as compared to any other facet of taxation that you can think of. Apart from the tax provisions on investments, which are the most benign, the only other areas in taxation which can bring a smile to anybody's face is the ones relating to the investments, the capital formation related incentives, and the SEZ provisions and the tax deductions which are available to industry to set up and promote industry in backward areas. Here we'd be focusing on that part of tax law which concerns investments. Initially, we would just do a quick roundup of the different areas in taxation which hold out different incentive provisions. Then we move on to look at the specific tax benefits which are available to investments in the mutual fund sector, both the debt as well as the equity. As we go, we would also look at some of the irritants in the tax policy, particularly when it comes to the equity fund investments. And we do along the route, we would do a quick sort of a reference check between the tax treatment for somebody who invests the mutual fund route to debts vis-a-vis somebody who is taking a debt exposure. In tax parlance, all assets are broadly classified either into a short-term asset or a long-term asset, depending upon what is the period of holding. So here again, this is this fundamental building block of the taxing and capital gain, and the discrimination, favorable discrimination, as far as if you are an investor, starts right from here. Because if you are a financial investor, then most of your investments, be it in shares or units of mutual fund, would qualify to be a long-term asset based on a lower threshold holding of 12 months rather than a 36-month holding period, which is applicable to all other assets, including real assets like your real estate investments or gold. In simple terms, what this means is now gold has become one hot investment destination for many of the investors. Now, if there is a unit which is packaged as an ETF and the underlying investment of that ETF is gold, then the participation of that unit in gold appreciation is going to be in direct proportion to the rise or fall in prices of gold. But for an investor who is taking a direct physical exposure in gold, he has to wait for 36 months for this asset to be called as a long-term asset. Whereas somebody who invests through the ETF route, he has to hold it for 12 months and can treat that as a long-term asset. Now, what is the big deal in treating it as a long-term asset? The advantages are, in fundamental terms, a long-term asset, if it is an equity-oriented mutual fund, a long-term gains on that, or even the long-term gains, as it gets the same tax treatment as long-term gains to direct equity exposures, which is they're basically exempt from tax. You don't have to pay any tax on that. And even on the short-term gains, the rate, which is the rate of tax applicable, is a lower 15% as compared to your the maximum marginal rate of 30%. Plus, of course, you have the tax breaks for investments into various schemes, which include the mutual fund, the notified equity schemes of most mutual funds. And then comes this the wealth tax waiver. None of the financial assets have to be disclosed for wealth tax purpose. They're completely exempt. And the pooling entities, be it mutual funds or be it the venture capital funds or be it a pension fund, all of them are completely treated as pass-through entities, which means that none of their income is taxed in their hands. Indexation. This is again a fundamental distinction in the tax law. If you place a deposit or if you have a plain vanilla bond or debenture exposure, you don't get to claim an indexation benefit. Whereas most FMP products are designed to give you the indexation benefit of, because they're structured as 1 year, 1 day, which is essentially to ensure that the investor gets an indexation benefit. Now what does this do to our high net worth individual? I'll just quickly move on to the other illustration, which is in the case of high net worth individual, to explain that scenario. So here we're talking about a same situation where the return is 100, so the tax rate here should be 31%, whereas the same investment, if it is routed through a mutual fund, the effective tax cost is at the first instance only 13. But the story doesn't end here. The fact that this investment is held for more than 1 year would mean that a person who exits this investment after holding it for a period of 1 year would actually have a reportable loss to show when he files a tax return. And this loss is available for set off against any other item of capital gain. And even assuming that this is set off against a taxable capital gain, which is at a 20%, otherwise goes to 20% tax, the break in terms of the cash inflow, in terms of the tax saving, would be 14 rupees here.
Thank you, sir. May I request Mr. Sunil Bhagat of Pondicherry to please come up and hand over a memento to Mr. Amit Kumar. Gentlemen, please put your hands together. Tax is not a very interesting subject. It's a very difficult, very dry subject, and Mr. Amit has done a wonderful job of presenting it as simple as it can be.